Through this video, we are going to learn about what is blockchain, how and when do we use it, what is the third web and cryptocurrency, what is the use of them. Okay, before digging into that, we have to know some basic familiar words like what is a Bitcoin, what is a cryptocurrency, and decentralized network, distributed ledger, etc. etc. Well, there is no problem if you don't know about them. We are going to learn them through this video. Okay, coming to the blocks. What is blocks? Blocks are used to build something big in a well mannered. Coming to the blockchain, a series of data record is stored in the blocks, and each block is connected through chains, makes them blockchain. Okay, coming to the blockchain. A blockchain is an immutable time-stamped series record of data. Immutable means it cannot be altered or modified at any point of time, that is distributed and managed by clusters of computer, which is not managed by a single entity, means there is no single server. They are managed by many group of clusters of computers. A blockchain is a storing of digital information of records in the type of blocks which are connected using a cryptographic technology using hash codes. Hash codes are required to connect each block. Without the hash codes, we cannot go to the another block. So first blockchain was introduced by Satoshi Nakamoto in 2008. Based on the blockchain design, it is impossible for data modification, but it is well distributed and decentralized. Do you know about digital currency or cryptocurrency? Means Bitcoin. Bitcoin was the first cryptographic currency which is used the blockchain technology. So coming to the next part, blockchain is a distributed ledger. We all know distributed means they are open to anyone, which is not confined to the single entity or the single server. So blockchain is a distributed ledger. In the figure, in the picture, we are available with three blocks connected using chains made in the blockchain, and well distributed ledger means they are distributed to everyone. So blockchain is a distributed ledger that is completely available to anyone. So one interesting property about the blockchain is once the data is stored in the blocks, it cannot be altered or modified. So how does it works? Well, so let's take a closer look at the block. So this is how a block inside a blockchain looks like. Each block consists of three forms. The one is the data of the block, the hash of the block, and the hash of the previous block. So once a data is stored in a block, its corresponding hash value is created, and to access the data of the next block, the hash value of the previous block is required. So if we want to change the data of the block, its corresponding hash value is also changed. So we cannot access the data of the next block by using the previously changed hash code, because the hash code from the previous one it is changed. So it is difficult to modify the data in a blockchain. And coming to the third element inside each block is the hash of the previous block. This effectively creates a chain of blocks, and its techniques makes them blockchain. So coming to the user of the blockchain, initially blockchain is used for cryptocurrencies like Bitcoin, but nowadays we found several use cases in many industries like financial applications using bank applications, and real estates using smart contracts. We can reduce the need of the third party, and health medical condition. Using medical condition, we used to store the data of the patient records securely and safely, and e-notary system using the smart contracts again, and the collection of the taxes. We can collect taxes without using of the in-person members or the third-party applications, and we can also maintain records using the blockchain applications. Third web or web 3.0. What is web 3.0? First, Basically, we all know about Web 1.0 and Web 2.0. Web 1.0 is nothing but a basic connection to the internet. It is the birth of internet and connectivity. Web 2.0 is the service of is the connection of internet services like Amazon, Facebook, Netflix, etc. etc. In this, we can only use the resources provided by the company. We cannot alter or modify the resources from the user end. For example, Facebook, a well distributed network, we can only use the resources which is provided by the company, but we cannot make any development changes from the user end. So the development ideas from the user end is in vain. In order to make it possible, Web 3.0 is introduced. Web 3.0 is the third generation of in, internet, where the devices are connected in a decentralized network rather depending on a server based databases. The new internet is a user centric, means we can have development from the user end also, and more secured and private and more connected. Web 3.0 is also known as the semantic web. Simply, Web 3.0 is the combination of the virtues of Web 1.0 and Web 2.0 by adding the machine or artificial intelligence into it. So this is how the basic connection of three generation networks looks like. Web 1.0 is centralized network, and 3.0 is decentralized, and 2.0 is well distributed network. Web 1.0 has a single server. Because of the single server, it is easy to maintain but difficult to scale, because each node can be connected easily, but it is difficult to maintain and calculate how many nodes are connected. And there is a single point of failure, means if there is a failure at one point, the whole system crashes within no point of time. And coming to Web 2.0, it is distributed system, spread computation across each node, but 3.0 is not like that. The nodes are nothing but the users here no node telling the other node what to do. But in 2.4, the computation is spread distributed across each node, means each node telling other node what to do and what not, or whatnot. So Web 3.0 has multiple servers, and Web 2.0, a system can be both distributed and centralized. Web 3.0 In Web 3.4, demand and failures can be better handled. Example: Bitcoin and Steemit, etc. etc. So, coming to the differences between the 2.4 generation and the third generation network, Web 2.4 is centralized and is dominated by the few key players, and it is censored and few dominant market. And Web 3.0, there is no ownership, impossible to censor, and there will be an unlimited new entrants. So let us see an example. Today, if you look at the majority of the major companies like Google, Facebook, WhatsApp, in the web they are in the Web 2.0 space. There is no room for competition for the new companies, because it is almost impossible for a new company to cope up with the already developed major companies, because the major companies has most money, best talent, and more compute power, and they have all the resources they need. So how can a new company can cope up with the already developed major companies? So Web 3.0 provides the solution for this. Web 3.0 decentralized application helps to start a new company today with ease. So there will be a lot of new entrants. Because of the lot of new entrants, and there will be a more competition. So Web 3.0 provides more competition. Low barrier means there is no censoring, like only these kinds of resources have to be included. So there will be the lower barrier, and there is an easier entry into the market. So Web 3.0, the third generation internet, provides the solution for this. So coming to the cryptocurrency, what is cryptocurrency? Firstly, what is currency? Currency is the basic need for everyone. Mostly we use digital currencies like notes or bank checks, etc. But what about digital currency? We today we have so much development. What about the digital currency? For that, cryptocurrency is nothing but a digital or virtual currency that is secured by cryptography using some hash code technologies, etc., which makes it nearly impossible to counterfeit or double spend the money which is we already spent on it. Many cryptocurrencies are decentralized network based on the blockchain technology. Cryptocurrency is the first one that uses the blockchain technology. So many cryptocurrencies are decentralized networks that uses the blockchain technology, a distributed ledger enforced by a disparate network of computers. So cryptography cryptocurrency is a internet-based medium of exchange which uses cryptographic functions to conduct financial transactions like banking, etc., etc. So cryptocurrencies leverage blockchain technology to gain decentralization, transparency, and immutability. So, coming to the uses of the blockchain, most of the blockchain applications uses decentralized ledger technology, which we already discussed in the previous slide. So, the uses of the blockchains, these are some basic applications that uses the blockchain technology. So, blockchain uses in cryptocurrency. As we all know, cryptocurrency, a basic cryptocurrency is a Bitcoin. By spreading its operations, blockchain by spreading its operations across a network of computers. Blockchain allows Bitcoin and other cryptocurrencies to operate without the need of the central authority. So there will be no transaction costs that happening between the third party and the user. So this not only reduces the risk but also eliminates many of the processing and transaction fees. Another major important use of blockchain is smart contract. A smart contract is a computer node that can be built into the blockchain to facilitate, verify, or negotiate a contract agreement. Smart contracts operate under a set of conditions that users agree to. When those conditions are met, the terms of the agreement are automatically carried out. Most of the smart contract applications are used in real estate transactions and e-notary system. So another some of the uses of the blockchain is they are using in a voting system and healthcare uses. In voting, each vote would be stored as a block, and there is each hash value is generated while storing in a block, so they are impossible to tamper with. So each vote would be stored as a block on the blockchain, making them nearly impossible to tamper with. In healthcare uses, each patient personal medical records could be encoded and stored on the blockchain with a private key using the hash codes, whatever the cryptographic technologies, so that they are only accessible to certain individuals, which is the only the patient can only be accessible to his own personal records, thereby ensuring the privacy and the protection to the details of the patient. So it provides an important resource to the healthcare tech users.
So this is how a traditional contract looks like. We have two parties and they will need a contract to sign or agree for the lease document, and they will also need a third party for the execution and the initialization of the contract. So contracts, whether they are leases, mortgages, loans, or for services, have been around a long time. But when something goes wrong and one party fails to perform their part of the contract, what happens? Then you have to go back and forth with them until they come around. And if they don't, then you have to call an attorney or a mediator to help pursue them. At that point, you are looking at spending hours and thousands of dollars to get the other party to simply execute their half of the contract. While traditional contracts require both parties to execute their responsibilities, smart contracts self-execute predefined actions when specific conditions associated with a given transaction are met. An easy way to understand smart contract is to view it as a programmable memory. So this is how the basic explanation of the smart contract and how do smart contracts works. A contract is created between the two parties, that is the buyer and the seller. The both parties remain anonymous. The contract is stored on a public ledger. In the second phase, some triggering events are set, that is the deadline, the amount of money is to be transferred, etc. The contract self-executes as per the written codes. In the third phase, the regulators and users, which means seller and buyer, can analyze all the activities using the smart contract. They can predict market uncertainties and trends. Coming to the real world example, imagine that you need to sell a house. It is a rather complicated and daunting process which entails a lot of paperwork and communication with different firms and people, as well as high levels of various risks. That's why the absolute majority of the house sellers decide to find an estate agent, which is a third party agent who deals with all the paperwork, markets the property, and act as an intermediary when the negotiations begin, overseeing the deal until it's closed. Moreover, the agency or the third party provides an escrow service which is especially useful in such transactions as the sums involved are normally quite big and you can't really fully trust the person you will be dealing with. Nevertheless, after the successful deal, the sellers and the buyer's agents will share around 7% of the sale price as their commission. This is the huge amount of data that we are losing to the third party agent. This amounts to quite a substantial final loss for the seller. It's situations like this where smart contracts could really come into handy and effectively revolutionize an entire industry. All the while making the process a lot less of a burden. Perhaps most importantly, they would solve a trust issue. Smart contracts works on an if-then principle, which means the amount that the ownership of the house will be passed on to the buyer only when the agreed upon amount of money is sent to the system. They also work as escrow services, meaning that both the money and the ownership right will be stored in the system and distributed to the participating parties at exactly the same time. Moreover, the transaction is witnessed and verified by hundreds of people, so the faultless delivery is guaranteed. As trust between the parties is no longer an issue, there is no need for an intermediary agents. All the functions that an estate agent does can be pre-programmed into the smart contract while simultaneously saving both the seller and the buyer considerable amounts of time. So, how do smart contracts works? So, the left side part is the basic about the buyer, and the right side part is the seller. Matchmaking of the seller and buyer, and there is a transaction of the money involved and receiving assets and distribution of the assets. So both the parties are registered in the smart contract, and there is an automated settlement of the contracts is distributed to both the seller and the buyer. There is no need of the third party. So how do smart contracts have to do with the blockchain? Smart contracts are kept on the blockchain and are executed automatically when a transaction is performed. And because data on the blockchain is immutable, cannot be changed or manipulated by anyone, smart contracts, once agreed upon, should help build trust between all parties as neither side can play with their contracts or their terms. So coming to the smart contracts benefits and smart contracts use cases. There are a lot of benefits involved in using smart contracts, which is they are interruption free. Interruption free. Nobody can interrupt the smart contract agreements, and they are autonomous body, and they can be anonymous also, and they are well secured and accurate always. There is a time-stamped series of a record of data always stored in the smart contracts, and they are fast and they have the fast performance and they are well cost effective, and they will provide trust between the two parties, and between the buyer and the sellers. So there is lot of use cases involved in the smart contracts, which is record storing. There is the storage of records and trading activities like stock markets, etc., and supply chain management of the goods or the products and mortgage loans, lease agreement, etc., and the real estate market, which is buying and selling the property and employment arrangements and copyright protection and healthcare services to store the personal record data of the patients and government voting systems and insurance claims, and there is a lot of use cases in IoT, Internet of Things, which is a major topic today.